Hello, everyone. This is Matt with the Fundamental Investing Institute. Welcome to this week's Fundamentals Unfiltered. We are recording this on Tuesday, January 20th, 2026. So this is the third video we're doing this week, the third episode of Fundamentals Unfiltered. Not this week. Rather, this is the third that we're doing since the beginning of the year. In the last two, I talked about Warren Buffett's career. I did a little video on Warren Buffett's influences and when he was running the investment partnership. And then I did one last week talking about Warren Buffett when he was running Berkshire. And I did that because Buffett had stepped down as CEO at the beginning of the year, and it really capped off this unbelievable career and investment run, and talked a little bit about some of the things that investors can learn. There were some themes in that I'd like to talk about more in subsequent videos. I am doing a blog series. I think we've put out two already. I'm going to try to go in depth on Buffett's career and the various lessons. I can just do far more writing a blog series than I can on these videos. So check that out. There's a couple of, like I said, there's a couple of themes that I really want to go into. But, of course, not doing the videos on big headlines since the beginning of the year. I've got a little catching up to do and kind of looking through everything since Jan 1st. The big one, and certainly the one that's most concerning to me, is that a little earlier in the month, the U.S. Justice Department, U.S. prosecutors announced an investigation into Jerome Powell based on some testimony that he gave last year regarding renovations of several Fed buildings. I don't think anyone believes that there's much merit to this. Jerome Powell himself put out a video saying that this is all a pretext for the president wanting lower interest rates and trying to pressure the Fed. So it's another thing that's bringing up this issue about Fed independence and Fed credibility that really should start to concern investors. Interestingly, markets have been pretty muted. I think the biggest impact's probably been on the continuation of the gold and silver rally, but interest rates haven't budged that much. Medium-term interest rates, I think there was a slight increase on the 10-year yield, a little bit of a sell-off of the dollar, but nothing huge. And of course, now with a lot of the uncertainty over Greenland and the tariffs, there's a lot of other market-moving headlines. But this Fed issue is certainly concerning. A lot of people, a lot of financial professionals, money managers, market commentators, economists came out against this. It seems that the administration, or at least certain people in the administration, most notably the Treasury Secretary, are vehemently opposed to this. The optics look horrible. Now, as far as the market not reacting as badly as we might expect, it's important to keep in mind that the Federal Open Market Committee consists of 12 members. And so even if you have a new Fed chair that's coming in, that's very much in the cooperation with the wishes of the White House, it's unlikely they're going to be able to get everybody on board for a majority vote. So that's one thing. Essentially, just a lot of people don't believe that the president's going to be successful in being able to impose his will on the Fed. It raises a bigger question for a lot of people that I've talked to, which is why Fed independence is actually important. And I don't blame anyone for not really understanding why that is. Certainly in my lifetime, I was born in the early 80s. I'm an old guy. One of the interesting things is that the Federal Reserve was generally watched, and this goes for investors, let alone average citizens. The Federal Reserve was generally watched when it was fighting crises, or in the late 90s when CNBC and other news outlets came together. They were looking at the interest rate picture to see the impact that would have on stocks. What was not a factor through most of that period was inflation. It really wasn't until 2021 and 2022 that inflation started to become a major issue. And that's kind of the interesting thing, is really the success of the Fed. Now, there were a lot of factors that were keeping inflation down, but certainly the Fed was successful in using monetary policy to what we call anchor inflation expectations. And kind of the paradox is that their success meant that people really weren't paying a lot of attention to the Fed and how they can impact inflation. So what I want to talk about is why this is so important, and it centers around the idea of a nominal anchor. A nominal anchor is a constraint that keeps in line inflation expectations. The reason inflation expectations are important is if investors and consumers believe that inflation is going to be higher in the future, they will act accordingly. They will set interest rates. In the case of lenders and investors, they will set interest rates at higher rates to compensate them for that higher inflation, expected inflation. Consumers will buy more, and that increases the velocity or the turnover of dollars into the economy, which itself creates inflation. So in our current monetary system, what is that nominal anchor? Because we're not on a gold standard, we're not on a silver standard. That nominal anchor is Federal Reserve credibility. And despite the inflation of 21 and 22, inflation expectations, as we say, remained well anchored. In other words, interest rates didn't really spike in a huge way. I know a lot of people said they did based on how low they were prior to the 21, 22 inflation. But by historical standards, inflation expectations were still relatively low. The Federal Reserve targets 2% inflation. That's how they quantitatively define price stability. And the reason they target 2% inflation as opposed to zero is the Federal Reserve does not want short-term interest rates at zero, because if short-term interest rates are zero or close to zero, then they have no dry powder to use to fight off a recession or a financial crisis. So the Fed is trying to introduce 2% inflation expectations to influence interest rates. They're also doing that as kind of a margin of error to prevent deflation, which is prices coming down. And for all sorts of reasons, deflation is bad. I won't go into that here. But I thought it would be worthwhile to kind of go through the history a little bit. And when we think about what a nominal anchor is, it's very helpful to go back to a time in the country's history when the country was on a gold standard. So this goes back to 1900. President William McKinley signed into law the Gold Standard Act. And what the Gold Standard Act did is it defined a dollar in terms of the quantity of gold. Specifically, it defined a dollar as 25.8 grains of 90% pure gold. This translated into about 23.2 grains of pure gold for every dollar. And if you do the math on that, the actual dollar price per ounce of gold, because there's about 480 grains in 1 troy ounce. So if you do the math on that, the dollar price per ounce of gold was $20.67. So that's the important thing. $20.67 was the price of an ounce of gold as of the 1900 Gold Standard Act. Now, what this did is it limited the quantity of money to the supply of gold that the banking system had. So in the late 1800s, early 1900s, you had a very unstable banking system and financial system. And so you had these crises, and that finally got Congress to pass the Federal Reserve Act in 1913. Now, if you read the Federal Reserve Act, what's very interesting is that it does preserve the gold standard. In fact, the Federal Reserve Act has no mandate for price stability, unlike modern times where central banks have some kind of legal mandate to maintain the stability of prices. The Federal Reserve Act did not. What it does is it specifies that the currency issue has to be backed by a minimum of 40% of gold holdings in the banking system. So the Federal Reserve Act very much preserves the gold standard, and when the Depression broke out, right, stock market crashes in 1929, and you have these later banking panics. What really defined the Depression was the collapse in the money supply. This led to lower prices. Much lower prices led to waves of default that led to more bank failures. Now, the Fed, in theory, the Federal Reserve was a very different institution then than it is now. In theory, it could have introduced bank reserves or engaged in open market purchases to increase the money supply, to prop up banks, to prop up prices. It didn't do this. It had a number of constraints, and really it was just central bankers they didn't have the institutional knowledge to react. But one of the constraints viewed by many was the gold standard itself. And the New York Federal Reserve in 1933 actually had to suspend convertibility. This is one of the reasons why you had the bank holidays when Roosevelt came in office. And actually, when Roosevelt came in office, a lot of states had already had bank holidays. So essentially, Roosevelt was just creating a federal policy around what was going on at the state level. Now, one thing Roosevelt does in 33 is he makes it via an executive order. He makes the private ownership of gold illegal, and he also prohibits the export of gold. So essentially, if you owned gold, because there was a huge run on gold supplies, both by depositors in the United States and foreign depositors. So you had people taking gold out of the system and essentially just putting it under mattresses or wherever. And a lot of gold was going overseas. So you had this huge run on gold, and with this huge run on gold, you had a collapse in the money supply. So what Roosevelt does is he renders this illegal. There was no private ownership of gold. The penalties were very harsh. I think it was a $10,000 fine. I mean, think about $10,000 in 1933. It was a $10,000 fine and or 10 years in prison. So the penalties for private ownership of gold were unbelievably harsh. People had to take their gold and bring it back into the banking system. He also prohibits the export of gold overseas. So essentially, this starts to bring monetary gold back into the system and starts to help inflate the money supply. Another thing that passes in 1933 is the Agricultural Adjustment Act. And there was an amendment in that act called the Thomas Amendment. And one of the things the Thomas Amendment did is it gave the president the right to reduce the gold content of the dollar. The president didn't do that right away. One thing he does do is he uses what's called the Reconstruction Finance Corporation, which was an agency set up in 1932. Roosevelt begins to use this in 33 to buy newly mined gold at increasingly higher prices. And it was this higher price of gold that starts to reflate the money supply. Prices start to go up. The economy begins to recover. Now, in 1934, April 1934, President Roosevelt signs into law the Gold Reserve Act. What the Gold Reserve Act does, this is after the buy-in from the Reconstruction Finance Corporation. With the Gold Reserve Act, the president redefines the gold content of the dollar. So it was 25.38 roughly with the Gold Standard Act. It was now 15 and 5/21 of 90% pure. Anyway, this translates into a $35 per ounce gold price. So you went from a gold price of $20.67 in 33 to $35 a year later. This higher price brings a lot of gold in from overseas, and the point of these gold programs is that it really starts to take monetary policy away from the Federal Reserve, puts it in the hand of the Treasury. But throughout all this, gold is still an anchor to the money supply, right? It's a means of fighting inflation and deflation, but it's still a part of the money supply. Now, in 1935, Roosevelt signs into law the Banking Act. The Banking Act creates kind of the modern structure of the Federal Reserve. So this creates the role of the Fed chairman that we now have. But throughout the 1930s, the Federal Reserve was very much in the back seat. It is really the Treasury that is very much in the driver's seat. And one of the other things that the 34 legislation does is it required gold supply to go from the banking system, the Federal Reserve, to the hands of the Treasury. So it puts even more authority into the hands of the Treasury. Of course, war breaks out. The United States enters World War II in 1941, and the Federal Reserve commits to pegging the interest rate, in other words, capping the rate of interest that the federal government would pay on its borrowing. So like all wars, it is paid for, World War II is paid for with a combination of tax increases and a lot of borrowing, but also money printing. So the Federal Reserve essentially is using newly printed dollars to buy up Treasury debt. And they're doing this throughout the war. Now, this policy is normally inflationary, but one of the things the government does during World War II is they have wage and price controls to try to keep inflationary pressures down. They also had credit controls. Now, of course, these policies couldn't remain in effect forever, and after the war, prices start to rise well into the double digits. And the Federal Reserve after World War II is trying to assert its independence so that they can start to address the higher prices in the country. Korea put a kind of threw a stick into the cog, as it were, because President Truman and the Treasury Secretary at the time, it was a man named Snyder, John Snyder, they were trying to get the Fed to commit to maintaining the peg throughout the Korean War. But at this point, prices were running like well over 20%. Inflation was running well over 20%. So one of the things that they do, there's this huge conflict. Truman invites some of the members of the FOMC to the White House and tries to get them to agree to maintain the interest rate peg that they had in place during the Second World War. The FOMC does not agree to this, but Truman puts out a press statement. The White House put out a press statement saying that they, in fact, did agree to maintain the interest rate peg. Well, then the Federal Reserve, particularly a governor named Mariner Eccles, who was actually the previous Fed chair, but he remained on the Fed Board of Governors, he issued a statement saying, no, we did not do that. Here are our notes. So you have this open conflict, and this is causing problems in the still nascent Treasury market, and the Federal Reserve, members of the Federal Reserve, and members of the Treasury have to come together to some kind of agreement. The Fed would not budge, rightfully so. So in early 1951, they meet, the Federal Reserve and the Treasury, and at this point, John Snyder was, I think, in the hospital for a minor procedure, so the Treasury was represented by the Assistant Secretary. His name was William McChesney Martin. And that's an important name, as we're going to see in a minute, because Martin actually becomes the next Fed chair. But at the time, when they meet in 1951, this is March of 1951, he is the Assistant Treasury Secretary. And they put out this very innocuous statement that says that the Treasury and the Fed had come to an accord. They had come to an agreement in which the Fed would support a 5-year issue for a temporary period of time, and after that they would be independent. Essentially, the Treasury bond market would now be subject to market forces and not subject to the interest rate floor the interest rate ceiling put on by the Fed during the Second World War. This is very important. The Treasury-Fed Accord, as it became known, was the real starting point for the Fed being independent of the funding needs of the United States Treasury. So this occurs in 1951. Now, the Fed chair at the time steps down, and President Truman appoints William McChesney Martin to the Fed chair. He thinks he's kind of getting this inside guy who's going to be accommodative. That was not the case. Martin was, by most accounts, a pretty effective Fed chair. He's the longest running Fed chair. He served until 1970, so he served from 1951 to 1970. His tenure is longer even than that of Alan Greenspan. Not by much, a few months, but nevertheless, he's the longest serving Fed chair. Now, during this time, what you have to remember is that in 1944, the United States, along with other major countries, negotiate a new monetary system. And Bretton Woods, New Hampshire, this becomes known as the Bretton Woods system. And during that system, the dollar becomes kind of the center of the system. All other currencies are tied to the dollar, so they have fixed exchange rates to the dollar. And the dollar itself is for foreign dollar holdings, not for domestic citizens, but for foreign dollar holdings. The dollar is convertible to gold at $35 per ounce. So throughout this period, gold still remains a nominal anchor. Not as important as it was under a true gold standard, but it remains part of the monetary system. Now, in the mid-1960s, you start to have foreign dollar holdings well in excess of the amount of gold that the United States Treasury held. And along with that, you start to see domestic inflation. Remember, this is during the period of the Vietnam War and all the domestic spending with the Great Society. So you start to have a big increase in government spending, and foreigners start to really lose confidence in the dollar. So there's a lot of foreign governments and central banks are converting their dollar holdings to gold. Gold supplies dwindle. And in August 1971, Richard Nixon convenes his top economic policy advisors at Camp David. And on August 15th, 1971, he announces that the gold standard, gold convertibility, will be suspended. August 15, 1971 is a key date here because this is when the United States and other major countries move from a system that is still at least nominally backed by gold into a true fiat system. And with a fiat monetary system, the currency is backed by the full faith and credit of the government, but it is not backed by any commodity or anything like that. So gold no longer plays the role of a monetary anchor. Now, here's the important point, is that in a fiat monetary system, the nominal anchor is central bank credibility. If the central bank does not have credibility over inflation and in setting inflation expectations, inflation is bound to spike. The United States learned this the hard way because in the 1970s, the Fed is under the helm of a man named Arthur Burns. Burns was a Nixon appointee, and Nixon was very aggressive in pressuring Arthur Burns to keep interest rates low, partially to help his reelection, to help his approval ratings. And the Fed has this stop-and-go policy where they raise interest rates a little bit in order to stem inflation, but they immediately pull back whenever there's any kind of backlash, political or otherwise. In the 1970s, the Fed basically loses its inflation fighting credibility completely. And so inflation at this point, by the late 1970s, it's running well into the double digits. It has been out of control for over a decade. It's hurting everyday Americans, businesses. The American economy is going through a period of what's called stagflation, where both the economy overall is stagnant, unemployment is high, and yet inflation is still running well above normal. This is where President Carter is forced to act. Now, initially, he replaces Arthur Burns with a man named William Miller, G. William Miller. Miller was an industrialist. Miller had a very short tenure at the helm of the Fed, not a very successful one. In 1979, Miller actually moves over to become Treasury Secretary, and the vacant Fed chair is filled by a man named Paul Volcker. The Volcker experience is very important. In a lot of ways, Volcker is kind of the real hero of the story. So inflation is running at double digits, and in October of 1979, Paul Volcker announces that the Fed is going to change its operating procedure. It is no longer going to target interest rates, rather it's going to target the money supply. There's a lot of controversy around this as to whether Volcker was really married to this idea of targeting the money supply, or whether it was kind of a pretext for just sending interest rates to a much higher level without having to actually announce that as a chosen policy decision. Either way, the impact of the policy, the Federal Reserve targeting the money supply, constraining the money supply directly, is that it puts the country into a very deep recession. This is in 81 and into 82. The unemployment reaches almost 11%. Credit is constrained. Huge wave of business failures across the country, especially in interest rate sensitive businesses. I think the federal funds rate hit a high of 20% or so. There's this enormous backlash, public backlash, and political backlash. President Reagan remains relatively supportive in public statements, but Treasury Secretary Don Regan was critical of the Fed in several public statements. Other members of the administration were critical, and certainly members of Congress of both political parties were very critical. In fact, one of them, a man named Henry Gonzalez, who was very critical of the Fed during this period, actually threatened to introduce legislation that would impeach Volcker. So in the summer of 82, the economy seemed to start to bottom out, and the Fed pulled back on its monetary tightening. Interest rates started to creep down. This is the beginning of the big run in the bull market in stocks. The economy starts to improve. Of course, President Reagan's approval numbers get much better. He wins re-election by a big margin. Inflation comes down to sustainable levels. Volcker eventually steps down in 87. He's replaced by Greenspan. Now, the Greenspan era, Greenspan's replaced by Bernanke. Bernanke's replaced by Janet Yellen. Janet Yellen's replaced by Jay Powell. Over that period of time, inflation remains pretty modest. In fact, through a significant period after the great financial crisis of 2008, inflation runs well below the Fed's 2% target. And this is what gives us in the 2010 period, 2010s, this is what gives us these ridiculously low rates that we saw. I think for a lot of people it was unsustainable, but one thing that happened during this time is that there was a kind of an implicit agreement among most presidents not to publicly criticize the Fed. Now, there's always been political pressure, so the idea of Fed independence is always one of degree. It's never been absolute. But if history tells us anything, and I'd say the biggest precedent is probably the Arthur Burns era in terms of the last time that we had a president who was this committed to pressuring the Fed to do his will, we certainly saw inflation expectations rise, and that is the real fear. The real fear is that if short-term interest rates are suppressed far below what would be the case otherwise, that it would be inflationary, and moreover, whether a less independent Fed is going to be viewed by market participants as being inflationary, then you see a spike in longer-term interest rates. Then you see higher inflation expectations. Then you start to see a possible run on the dollar. So there are real implications here. Again, markets have been relatively stoic, but I think it's important to go through the history. Now, I am in the process of doing a long-form blog post on this, probably going to be over 2,000 words or so. I'm going to go into this on some detail. In fact, I'm using the draft of this as opposed to our normal show notes. We'll post that. We'll try to post it at the same time that we post this video. But anyway, thank you for listening in. I know that was a little bit long-winded, but it's very important to kind of go through the history of the Fed and to understand why the credibility of the Fed and the independence of the Fed is so important. With that, hope everyone has a great week. As always, focus on the fundamentals, and we'll see you next time.